So imagine a company that just grew its top-line revenue by like nearly 85% in a single year.
Right, which is already a staggering number for any established business.
Yeah, it's massive. And they're achieving these software-like profit margins of almost 57%, all while selling highly complex physical hardware.
And the product they actually manufacture is functionally sold out for the next 4 years.
Exactly.
Yeah.
So now imagine that same company reporting its best quarterly earnings in history, only to watch its stock immediately plunge, like 9%.
It's wild. It completely defies the conventional wisdom of how markets are supposed to price fundamental strength.
Welcome to the paradox of SK Hynix. I mean, it just feels broken, right?
Oh, absolutely.
It feels like the fundamental physics of the stock market just stopped working entirely.
While you're looking at a business operating in an environment of total scarcity, essentially printing cash, and the market's reaction is just to aggressively sell it off.
Right. Which is exactly what we're deep diving into today. Because if you're listening to this, whether you actively manage a portfolio or you're just trying to understand the massive economic engine driving the artificial intelligence boom.
This specific disconnect is a perfect case study.
Yes, a total masterclass in separating market noise from fundamental reality. We're going to unpack whether this drop is, a structural crack in the AI narrative or just a classic violent mispricing.
Right.
And just to be clear up front, we're here to pull apart the mechanics of this market drop today. We're looking at the raw data, the institutional flow, the technology. We are not giving financial advice or telling anyone what they should buy or sell.
No, definitely not. We're just impartially analyzing the numbers.
Okay, let's unpack this. So before we can even really understand why the stock dropped, we first have to understand what makes this asset so valuable in the first place, right? What does SK Hynix actually do?
Well, the entire disconnect really centers around their position in high bandwidth memory, or HBM. We constantly hear about the massive AI accelerators, the cutting-edge GPUs designed by the major tech giants to process the algorithms that make AI actually work.
The brains of the operation.
Exactly. But a processor, no matter how advanced it is entirely useless if it cannot access data fast enough.
I always try to visualize this because the physical bottleneck is just fascinating to me. Standard memory architecture always reminds me of like a researcher working in an office, but the library they need is 3 miles away.
That's a great analogy, actually.
Right. So they have to walk miles to get a single book, read it, and then walk back to return it. It doesn't matter if that researcher is a world champion speed reader. The GPU, their output is completely limited by that transit time to the library.
Yeah, standard memory limits the AI. It throttles it.
So what does high bandwidth memory do differently?
High bandwidth memory is like taking that entire massive library, building it as a skyscraper directly on top of the researcher's desk, and installing a high-speed chute that drops 10,000 books onto their lap the exact millisecond they ask for them.
That visual is wild. But it captures the data flow perfectly, I think. Standard memory throttles it. HBM unleashes it.
Exactly. And the mechanism making that chute possible is this physical engineering marvel called vertical stacking.
Instead of placing memory chips side by side on a circuit board.
Right. Because placing them side by side takes up space and it increases the physical distance the electrical signals actually have to travel. So HBM stacks the silicon chips directly on top of one another.
But connecting those layers is where the technological moat actually exists. It's not just gluing them together.
No, not at all.
They use something called through silicon vias, or TSVs. Explain the mechanics of that, because this is where competitors seem to just get completely stuck.
Well, to connect those vertically stacked chips, manufacturers have to punch microscopic holes straight down through the silicon layers.
Literally drilling through them.
Yes. And then thread them with highly conductive material to pass the electrical signals. I mean, imagine trying to drill a perfectly straight elevator shaft down through a 12-story glass building.
Okay, sounds stressful.
And doing it without shattering a single pane of glass on any floor.
Oh, wow. And doing that millions of times on a piece of silicon the size of a postage stamp.
Exactly. Which brings us right to the yield problem.
Right, the DSEC rate.
Yeah, if you crack the silicon on, say, layer 4, or the conductive material just doesn't align perfectly, you have to throw away the entire multi-chip stack.
So it is incredibly expensive to get wrong.
Incredibly expensive. But SK Hynix figured out how to execute this atomic-level precision at scale without a massive defect rate, long before their competitors even understood the process.
So that early lead establishes this incredibly brutal technological moat.
Absolutely.
Because when a major AI hardware company designs a new GPU, They are optimizing the architecture, specifically around SK Hynix's memory, right? To squeeze out every ounce of compute performance.
Right. They can't just pivot to a different memory supplier later without completely redesigning their multi-billion-dollar chip.
So the switching costs are effectively prohibitive,
It creates a captive audience. The buyer has to use the supplier's product, or their own product just fails to perform.
which leads directly to the financial reality we're seeing today. I mean, let's look at those numbers.
They're pretty shocking.
We're looking at a trailing 12-month revenue growth of 84.98%. Top-line revenue nearly doubling from
Pricing power here.
a gross margin of 68.34% and a net margin of 56.89%.
Which is insane for hardware.
Right. Physical hardware companies historically fight for, like single-digit or low double-digit net margins. 57% is unheard of outside of pure software companies.
It reflects a supplier dictating terms in an environment of total scarcity. When the alternative for the buyer is literally halting their own production line, the supplier can charge a massive premium.
So here is my big question. With a staggering 57% net margin and absolute pricing power, why did they slightly miss Wall Street's operating profit estimates last quarter? How does that even happen?
What's fascinating here is that the miss wasn't driven by softening demand or skyrocketing raw material costs.
Right.
It was driven entirely by aggressive capital expenditure, or CapEx.
Oh, so they are just taking that cash and immediately burying it into building new fabrication plants.
It's exactly. Buying next-generation equipment, building factories. SK Hynix is heavily reinvesting in capacity.
And the timeline behind this reinvestment is critical because industry experts and management project that AI memory supply will remain structurally tight all the way through 2028.
Right. High bandwidth memory capacity physically cannot be built fast enough to keep pace with projected global spending on AI infrastructure right now.
So missing an arbitrary Wall Street profit estimate by a few cents because you're building more factories is actually, well, it's a strategic masterstroke.
Yes. They are choosing to secure and lock in their long-term market dominance for the next 4 years, rather than artificially inflating a single quarterly profit metric to appease day traders.
Which shows incredible confidence from management in the duration of this AI cycle. They are fortifying the moat,
Exactly.
which sets up the grand disconnect we are exploring today. If the fundamentals are this strong, if the technological lead is secured, and they are essentially sold out of product until 2028.
Why are investors dumping the stock?
Yes. Why is it bleeding? We are looking at a sharp, violent pullback of almost 9%, bringing the price down to 130.17.
Well, you have to zoom out and look at the macro environment SK Hynix operates within to understand that price action. Even with this aggressive 9% haircut, the stock is still up roughly 179% year to date.
Sure.
And over the trailing 52-week period, it's up over 403%. You do not see 400% annual gains without extreme volatility along the way.
Good point.
Yeah.
And the current macro environment is incredibly unforgiving right now anyway. I mean, the broader NASDAQ index is teasing correction territory.
Right. There is a sweeping sell-off happening across the entire semiconductor and tech space.
Yeah, Marvell Technology dropped 8%. ARM Holdings took a 9% hit. It seems like there's this sector-wide gravitational pull dragging everything down completely, regardless of the individual company's merit.
Exactly. And to determine if this drop is genuine panic about the AI boom ending or just a calculated reduction of risk by the smart money, we have to look at the internal mechanics of the trading flow.
Okay, so volume and insider activity.
Yes. Specifically, the trading volume during this recent pullback is sitting at about 0.9 times their 10-day average.
Wait, so it's actually lower than normal?
Exactly. We aren't seeing a massive institutional stampede for the exits. If major funds were convinced the AI story was fundamentally cracking, that volume would be spiking as everyone raced to liquidate their positions.
So low volume sell-off implies a buyer strike rather than a seller's panic.
Right. The broader market is anxious, so buyers step back, and the stock drifts significantly lower on relatively light trading.
Got it.
But the much more critical metric is the insider flow.
Oh, this part blew my mind.
Yeah, over the last 90 days, the net shares traded by SK Hynix insiders is exactly 0.
Nobody in the executive suite has sold a single share. That is wild to me.
It's a huge signal.
If you are an executive sitting on a 400% gain over a single year, and you genuinely fear your massive multi-billion-dollar factory expansion is a mistake.
Yeah.
Human nature dictates you take some chips off the table.
Right. You lock in some profit.
The fact that the people with the most transparent view of the order book are holding tight is a massive signal of internal confidence.
It really is. Jim Cramer actually recently flagged this exact dynamic, defending the stock because the top-line results were just undeniable.
Right, he called the profit miss not that bad. But Wall Street broadly is just ignoring the underlying strength. Is it just institutional AI fatigue? Are they throwing the baby out with the bathwater here?
It appears so. Funds are deciding to take profits universally across the sector, completely ignoring the nuance of which specific companies have actual pricing power.
And SK Hynix is uniquely vulnerable to that kind of broad market fatigue because of a metric called beta, right?
Yes, they are carrying a beta of 1.76 right now.
Meaning every time the NASDAQ catches a cold, SK Hynix gets the flu.
Basically, yes, it amplifies the macro anxiety. If the market drops 1%, SK Hynix is statistically inclined to drop almost 2%.
That 1.76 beta is the mechanical explanation for the severity of this drop then.
Right. When you see a broad sector rotation out of tech because of inflation fears or, geopolitical anxieties, highly conductive assets like SK Hynix feel the heat twice as intensely.
It's a mechanical repricing of risk across the market.
Exactly. Entirely detached from SK Hynix's actual business operations.
The business is thriving, but the neighborhood is burning down, and their house is catching the heat.
That's one way to put it, yeah.
But a critical thinker can't just assume the market is entirely foolish, right? If we strip away the short-term panic, there have to be real structural risks the market is trying to price in right now.
Oh, absolutely.
The most obvious being that beta. If the NASDAQ goes into a sustained multi-month bear market, the strong fundamentals won't act as a parachute.
No, they won't. In a true liquidity crunch, correlations go to 1. Everything gets sold to raise cash, regardless of the balance sheet.
But here's where it gets really interesting for me. What about the deeper existential risk specific to SK Hynix? Like, what if AI demand suddenly cools off? Doesn't that aggressive, high-cost CapEx expansion suddenly turn into a massive financial anchor?
That is the primary bear case. The boom and bust cycle of semiconductor manufacturing is historically brutal.
Right.
You commit tens of billions of dollars to build a cutting-edge fabrication plant because demand is white hot. But it takes years to construct and equip that facility.
And historically, by the time you cut the ribbon on the new factory, the technological cycle has peaked and the demand has evaporated.
Exactly. You are left with a massive, state-of-the-art factory you no longer need, and you still have to eat the massive depreciation costs on your balance sheet for a decade.
Which just crushes free cash flow and destroys margins.
Yeah.
So if the current AI boom is merely a massive pull forward of demand that tapers off sharply in 2025, their current expansion is terrifying.
They are spending billions today assuming the music never stops. It's a very valid fear for institutional investors. The bullwhip effect in supply chains, where over-ordering during a shortage leads to massive inventory gluts later, is a well-documented phenomenon.
But this is where the industry backchatter gets genuinely fascinating.
Right.
Because there is a speculative catalyst floating around that entirely shifts the risk profile of that massive expansion.
Yes, the multi-year agreements.
Rumors strongly suggest that the major AI GPU makers are so desperate to secure high-bandwidth memory supply that they are negotiating multi-year prepaid capacity agreements with SK Hynix.
Which is huge. The mechanics of a prepaid agreement fundamentally alter the risk on the balance sheet. Think of it like a real estate developer pre-selling the top 50 floors of a luxury skyscraper before ground is even broken.
Oh, wow. So the builder gets a massive injection of upfront cash.
Right.
They can fund the construction of the building without taking on high-interest debt or leveraging their own margins.
And more importantly, it transfers the inventory risk entirely from the manufacturer to the buyer.
That makes so much sense. The GPU makers are essentially financing SK Hynix's expansion because their fear of not having memory to build their processors is greater than the financial risk of over-ordering.
Exactly. If these prepaid agreements materialize, it completely neutralizes the bear case regarding CapEx leverage.
It proves the balance of power has completely shifted. The companies physically manufacturing the memory hold all the leverage over the companies designing the software.
It's a total paradigm shift.
Okay, so assuming they navigate these risks, and assuming this prepaid rumor holds water, we have to look at how the company is valued today.
Yeah.
Because this is the part of the data that feels like an actual glitch in the market matrix.
Let's lay out the valuation profile.
So we have a company with a market cap of over $1.3 trillion. They're growing revenue at 85%. They hold a functional monopoly on the most critical hardware bottleneck in artificial intelligence.
Right.
And yet, they are trading at a trailing 12-month price-to-earnings ratio of 17.6x and a price-to-sales ratio of 10x.
It's almost hard to believe a 17.6x multiple is something you model for a mature, slow-growing legacy industrial company or like a consumer staples brand.
Right. You expect tech companies driving massive secular trends to trade at 40, 50, or even 100 times earnings.
Exactly. The market has completely compressed their valuation multiple out of macro fear.
It's wildly detached from their growth rate. It's like finding a winning lottery ticket in the discount bin. So, looking toward the 2026 horizon, what does this all mean for the big picture? How does this multiple expansion actually happen?
Well, the first catalyst is simply macro stabilization. Any shift toward looser monetary policy, like unexpected rate cuts from central banks, disproportionately benefits high beta assets.
So, the moment liquidity flows back into the NASDAQ, SK Hynix's 1.76 beta works in its favor on the upside.
Exactly. Amplifying the recovery just as it amplified the sell-off.
Got it. What else should we watch for?
The second catalyst has to be the post-earnings integration cycle. Institutional analysts are notoriously slow to adjust their long-term models. They tend to wait for the dust to settle.
Makes sense.
So as they fully digest the reality of supply remaining tight until 2028 and begin to model in the potential of prepaid capacity funding, we are highly likely to see significant upward revisions in earnings estimates.
And an upward estimates revisions force portfolio managers to reevaluate their weighting in the stock.
Right. And finally, looking at the third and fourth quarters of 2026, SK Hynix is expected to showcase their next-generation memory architecture, HBM4, at major industry hardware conferences.
Reaffirming the technological moat, proving they aren't just riding the current yield advantages, but are already setting the standard for the next generation of AI compute.
Yes. The synthesis of all this data paints a very clear structural picture, really resulting in a bullish score of 8 out of 10, targeting a multi-year hold horizon of 12 to 24 months.
Okay.
We are witnessing classic short-term multiple compression, creating a high-conviction entry point. The market sold off the sector, SK Hynix got caught in the crossfire, but their underlying engine is running with unprecedented efficiency.
So the critical watch point is simply waiting for institutional capital to realize they misread the mechanics of the AI memory sell-off.
That's exactly it.
We started this deep dive looking at a paradox. An 85% growth rate met with a 9% stock drop. But pulling back the layers, the machinery operating beneath the panic is structurally sound.
Incredibly sound.
SK Hynix is fortified by an insurmountable lead in vertical stacking and TSV manufacturing. They command 57% net margins in a physical hardware space, and they are leveraging that massive cash flow to lock down the future of AI supply.
And the takeaway here extends far beyond a single asset.
Right.
It's about how to dissect market flow, identifying low-volume sell-offs, noticing zero insider selling, and understanding the strategic necessity behind aggressive CapEx.
Those are the signals that actually matter.
Yes. The daily ticker tape is driven by emotion and broad macro anxieties, but the underlying financial and technological data tells the actual story.
It changes how you view the market entirely.
Yeah.
But I want to leave you, the listener, with one final lingering thought to mull over as you watch this AI landscape evolve on your own.
Yeah.
We discussed how high bandwidth memory is the absolute bottleneck and how GPU designers are potentially prepaying years in advance just to secure their place in line. If computing memory truly becomes the absolute most constrained physical resource on the planet by 2028, how will that shift the geopolitical and economic balance of power?
It's a huge question.
Will the incredibly famous multi-trillion-dollar software and design companies eventually find themselves entirely at the mercy of the quiet industrial firms physically stacking the silicon?
The architects versus the bricklayers.
Exactly.
But the bricklayers own all the clay.
A massive shift in leverage. Thank you for joining us on this deep dive today. In a landscape flooded with market noise, reactionary panic, and relentless information overload, keep seeking out the underlying mechanics, rely on the raw data, and never let the red arrows on a screen dictate your understanding of reality. We'll catch you on the next one.